This is Phil Cote, and welcome to this module on instruments, execution, and exposure. Now that we have a basic understanding of commodity markets, the next step in our learning is understanding how and what we trade. So what we will cover in this short module are the market types, the instruments that we may trade, exposure, so how do we make or lose money arising from transactions, and finally execution, so how do we execute a trade. Generally, there are two markets in which counterparties may transact, one which is defined as over-the-counter and one as exchange-traded. At a very high level, there are three main differences between those. In the case of OTC markets, everything that is discussed and transacted is done bilaterally between two counterparties. So that's deemed as counterparty A and counterparty B. And the terms are can be customized because it is a bilateral transaction. In the case of exchange-traded markets, it's a little bit different. Now, counterparty A and counterparty B may transact on the exchange, but they will transact on the contract where the terms are standardized by the exchange. The impact of standardization means increased liquidity. Also, in an exchange, there's the concept of a clearinghouse, which we'll discuss a little bit more at length in a minute. And what happens is counterparty A and counterparty B, when they execute on the exchange, they are matched. So effectively, the execution is anonymous. And as soon as they are matched on the exchange, the transaction is executed, the exchange itself becomes the counterparty for both counterparty A and counterparty B. So they do not know that they've traded with each other. Now let's discuss a little bit more at length the concept of clearinghouse. It is super important in financial markets. The clearinghouse acts as a centralized counterparty. It does so through a legal mechanism called novation. So what that means is, as I described, counterparty A goes on the exchange, counterparty B goes on the exchange. Let's assume they both put an order and are matched. Instantly upon being matched, the exchange itself, the clearinghouse, substitutes itself for the counterparty. The beauty of such mechanism is because the clearinghouse also has margining, so counterparty A and B have to provide margin initially when they transact and have to provide additional margin in cases where they lose dollars or money on their transactions. The impact of this is that all obligations with the exchange or the clearinghouse are collateralized. So effectively, it reduces credit risk by ensuring performance on the contract. The concept of waterfall is an important concept. That's what provides additional security when transacting on an exchange. I've described how transactions are collateralized with market participants, and the way an execution works through a clearinghouse is a market participant will deal through an exchange member called a clearing member. And what happens in case one counterparty, let's say counterparty A, fails to deliver on its obligation or does not have enough collateral, the next layer, the waterfall, will be the clearing member who will have to provide additional capital to perform on the exchange. If such mechanism fails, it goes in further into a waterfall all the way to at the end, it becomes the actual equity of the collateral of the clearinghouse. And that provides a solid mechanism to eliminate or reduce systemic risk, which would be defined as the risk of a market participant defaulting in its obligation and transmitting itself to further defaults in the system. In terms of instruments, we'll cover this very, very briefly, simply because what we'll be concerned with are primarily futures contracts. So let's head to the Chicago Mercantile Exchange website. This is the futures contract for WTI crude. And you can look through the exchange website. There are many, many types of contracts. What I really want to focus on are things. We'll discuss how to read quotes a little bit later. But as I've described, futures contracts have standardized terms. Those can be found through the contract specifications. So there are many things that are important for every contract that you may trade. Obviously, how the quantity of the contract, how to read quotes in terms of, in this case, it's US dollars and cents per barrel, and also, very importantly, the rules at settlement. So whether the contract that you trade is physically delivered or it's financially settled. It has implications in terms of if you don't exit your position before expiry of the contract is physically delivered, you will have to take delivery or provide delivery to the exchange. The other thing I've mentioned at this point is futures contracts standardizations. In this case, for WTI crude. So the grade is WTI crude oil, which is defined in the exchange rulebook. The location delivery is Cushing, Oklahoma. And then we see various quotes. So all these quotes here are for different delivery months. You've noticed here January 2022, February, and so on. So those all have the same grade, delivery location, but reflects different pricing because of the different delivery timing. The next concept is exposure. Now, that is a concept which is often confusing for people getting into trading. And a key concept there is physical exposure is very distinct from price exposure. When we trade, we seek to make financial gains through trading, and that is provided through price exposure. Let's work it through an example that is best understood this way, something totally irrelevant in terms of commodity markets, but probably more effective at the learning. You are buying a house today, average house in an average city worth $500,000. So here we assume that all houses are the same. In the city, no differences in price. And the choice we have from a contractual perspective is we sign option one, we sign a contract and purchase the house through agreeing on a price of $500,000 for possession in 3 months. Option two would be the same house, same delivery timing, possession in 3 months, but instead of agreeing on a fixed price, we agree to purchase the house at the average house price according to an index for that city at the time of possession. So the question here, which one has financial exposure and why? Many folks are actually confused in this case, and in terms of option two being the one that has financial risk, but it's in fact option one that has financial risk or price exposure. And here's how to think about it. So let's say house prices go from $500,000 to $1 million between the time we sign the contract and the time we take delivery. In the case of option one, what we have is we've agreed to purchase the house at $500,000 and it is now worth $1 million. So we can resell the house and effectively collect the additional $500,000 in profit. Whereas in option two, the price of the house according to our contract will be the same as the market value of the house. Therefore, if prices move to $1 million, we pay $1 million 3 months' time, and then we sell it back for $1 million. So therefore, we have neither made nor lost any capital through that transaction. In terms of execution, so main rule from an execution standpoint, once we've covered and done all the analysis and have the same market view and so on and trade, you can be certain if we have 100 traders with the same market view, we will most likely end up with 100 different financial outcomes for execution. Now let's first start on how to read quotes. So those are taken from the same web page I've showed you on the CME. So I've actually highlighted OHLC. So and this is an important concept. So O for open, H for high, L for low, and C for close. OHLC time series are actually very common in finance. So if you extract time series of prices and want to do analysis, when you hear OHLC, it means that for each day that you search historical prices, you are going to get 4 prices. So the open is the price at which the trading day open, the high is the high during this trading session, the low is the low, and the close, often referred to as the settlement price, is the actual official mark-to-market or settlement price of the exchange at the close. And that is what margin is actually computed on. Types of orders. So an order is fairly important. An order describes the execution that you seek to achieve through a set of instructions. Common aspects that or terms that need to be part of an order would be first a legal entity. you are using. So if you are, for example, if you're buying stocks through your own account at a discount broker, the legal entity is yourself, your account. If you trade for a company, it would be the legal entity of the company. Secondly, the period that is valid until. So most orders are day orders, meaning you put an order sometimes during the day, the order is automatically canceled at the end of the day. You can also choose to put an open order or go till canceled, meaning that the order will remain valid until you actually cancel it. Obviously, whether the order is a buy or sell and the quantity of the order in number of contracts that you trade. And on the price side, this is where things might get a little bit confusing at times. The most common type of order will be a market order. So when you submit a market order, go to an example, it will actually execute as per which you have bids or offers in marketplace on exchange, meaning that will be executed at whatever price someone is willing to sell if you have a buy order, and vice versa if you have a sell order. Unlike a market order, a limit order will only execute at the order price or a better price. And a stop or a stop loss order becomes a market order once a bid or offer exists at a specified price. So stop loss orders are often found on long position where, for example, you don't want to lose more than 10% of the market value. So we'll actually put a sell order at a level 10% below its market price. An example of orders. So this is for market order. So what I've put there is typical of what you may see on an exchange or transaction marketplace. So it's called the exchange stack in this case. So what you would see would be the bid or offers in a stack. So the first row being the highest bid and the lowest offer. What you see on each side would be the quantity related to those orders. So what this tells us is the best bid in the market is at $84.90, and that is for 40 lots contract. On the other hand, from an offer side, it's $85.20 and for a quantity of 10 lots. So as an example, so if we place a market order to buy 50 lots, question would be what price do we get filled at when we get confirmation back from the. So when we put a market order, as mentioned, it gets executed at market prices and it goes down the exchange stack. So in this case, since we put a buy order, we will need to buy from someone willing to sell. So we would effectively have 10 lots executed at 85.20, 20 lots next at 85.40, and 20 lots at 85.50, meaning that the average price executed for a market order will be 85.20, 85.40, 85.40.